Good evening. Tonight we're diving into a topic that touches every single one of us, whether we realize it or not. Oil. Oil is often called the lifeblood of the global economy, and for good reason. It powers our cars, planes, and ships, moving people and goods across continents and oceans, and connecting distant corners of the world in ways we often take for granted. But oil's impact goes far beyond just fueling vehicles. It generates electricity for our cities, heats millions of homes during cold winters, and serves as the foundation for countless everyday products. From the plastic in your phone case, to the fertilizers that help grow our food, to the asphalt beneath our feet, oil is everywhere. Because oil is woven into every aspect of modern life, its price sends ripples through the entire economy. When oil prices change, the effects are felt in the cost of groceries, electronics, clothing, and nearly everything we buy or use. When oil prices rise, transportation and business costs go up, making it more expensive to ship goods and run factories. This often leads to higher prices for consumers at the checkout counter. On the other hand, when oil prices fall, companies and families can see some relief in their budgets. That's why oil prices are watched so closely, not just by governments and investors, but by everyday citizens who feel the impact in their wallets. The price of oil can influence inflation, job markets, and even the stability of entire countries. Understanding what drives oil prices isn't just for economists or industry insiders, it's key to understanding the economic forces that shape our daily lives, from the price of a loaf of bread to the cost of heating our homes. Geopolitical events, production decisions by oil-producing nations, and the development of new technologies can all shift oil prices dramatically, sometimes overnight. These changes can have immediate and far-reaching effects on economies and individuals alike. Tonight, we'll break down the latest developments in this critical market, helping you understand why oil truly matters to everyone, everywhere. Today, December 26, 2025, oil markets are quiet after the holidays. Brent crude, the global benchmark, dipped slightly to $62.08 a barrel, while U.S. West Texas Intermediate fell to $58.20. These small moves reflect a market in equilibrium, with thin trading typical for this time of year. Even minor price changes are closely watched, as they set the stage for bigger shifts ahead. Today's calm masks a year of dramatic trends and underlying tensions. These prices are the result of a year-long tug-of-war between supply and demand. As we look at these numbers, we'll see how larger global forces are shaping the market. Despite today's stability, 2025 has seen oil prices drop sharply, the biggest annual decline since 2020. Brent crude is down 17% since last year. WTI has fallen 19%. For consumers, that means cheaper fuel, but for oil-dependent countries, it's a budget crisis. The main reason: global supply has outpaced demand, leading to a surplus and falling prices. This oversupply has forced energy producers and governments to rethink their strategies. The market has shifted from fears of shortages to worries about too much oil. As we head into 2026, the big question is whether this trend will continue, or if new risks will tighten the market again. The answer will shape economies worldwide. The main driver of falling prices in 2025 is a surge in global oil production. OPEC+, led by Saudi Arabia and Russia, has struggled to limit output, while U.S. shale producers keep pumping at record levels. Advances in drilling technology have made American oil cheaper and more abundant. The result: a classic oversupply, with storage tanks filling up and sellers forced to cut prices. If production stays high and demand remains uncertain, prices could stay low into 2026. That's good for consumers, but tough for oil-dependent economies. The battle to balance supply will be a key story in the year ahead. Oversupply has dominated 2025, keeping oil prices relatively stable and markets calm. But now, a new and potentially game-changing risk looms on the horizon: one that could upend the delicate balance. The US is preparing to impose a strict quarantine on Venezuelan oil, a move that could have far-reaching consequences for the global energy landscape. Venezuela, despite enduring years of political and economic crisis, remains a significant player in the oil market. The country still manages to export hundreds of thousands of barrels of crude oil every single day, providing a crucial supply to buyers around the world, especially in Asia. If the US quarantine goes into effect, it could sharply cut off this vital supply almost overnight. Such a sudden disruption would inject a new level of uncertainty into the market, likely supporting or even driving up prices as traders scramble to adjust to the new reality. The plan is designed to pressure Venezuela's government without resorting to direct military confrontation. Instead, the focus is on intercepting oil shipments at sea, with the operation expected to last for at least 2 months, long enough to send a strong message and potentially force political change. This bold move has traders and analysts on edge as they try to anticipate how major buyers, especially China, one of Venezuela's largest customers, will respond. Will they seek alternative sources or attempt to bypass the quarantine? Even the mere threat of a quarantine is enough to make buyers nervous, prompting them to secure supplies elsewhere and pushing up prices in other markets. The ripple effects are already being felt, with volatility increasing across global exchanges. It's a stark reminder of how quickly geopolitics can shake up the oil market. A single policy decision, thousands of miles away, can send shockwaves through supply chains and impact economies worldwide. For most of the year, oversupply and steady production kept things calm. But now, with the threat of a sudden and significant disruption, the market's sense of security could be reversed in an instant. The outcome of this standoff in Venezuela will be crucial for oil prices as we move toward 2026. If the quarantine is enforced, the world could see a rapid tightening of supply and a surge in prices. The big question now is whether other major producers, like those in the Middle East or Africa, will be able to ramp up output quickly enough to fill the gap left by Venezuela, or if the market will face a prolonged period of volatility and higher prices. The next few months will be critical, as the world watches to see how this high-stakes geopolitical gamble plays out, and what it means for the future of global energy. In West Africa, Nigeria, one of the continent's top oil producers, faces ongoing security threats. A recent US-Nigerian airstrike targeted militants in Sokoto, far from the country's oil infrastructure in the Niger Delta. Because the attack didn't threaten oil facilities, markets barely reacted. Still, Nigeria's history of pipeline attacks means traders remain alert to any sign of trouble spreading south. Not all geopolitical news shakes the market. Location and context matter. For now, the risk to supply is low, but instability remains a concern. The market's cool response shows how carefully traders assess real threats. Another major story dominating headlines is the ongoing push for peace between Russia and Ukraine. After months of conflict, both sides have returned to the negotiating table, with diplomats and world leaders working tirelessly to find common ground. The stakes are high, not just for the countries involved, but for the entire global community, as the outcome of these talks could reshape international relations and economic stability. If a breakthrough is achieved and a deal is reached, one of the most immediate impacts could be the lifting of sanctions on Russia's vital oil sector. This would allow Russian oil to flow more freely into the global market, potentially increasing supply and easing some of the pressure that has built up over the past year. Energy markets are watching these developments closely, as any change in sanctions policy could have ripple effects across the world. Recent high-level talks between Russian and US officials, along with cautious optimism from both sides, have raised hopes that a diplomatic solution might be within reach. These discussions are being followed by analysts and investors alike, as any sign of progress could shift market sentiment overnight. In a scenario where sanctions are lifted, Russia could rapidly ramp up oil exports, flooding the market with additional supply. This surge could drive oil prices lower, offering relief to consumers, but posing new challenges for producers in other countries. This potential increase in Russian oil stands in sharp contrast to the situation in Venezuela, where ongoing instability and the threat of further disruptions could remove significant supply from the market, pushing prices higher instead. As a result, the oil market finds itself pulled in opposite directions by these two powerful geopolitical forces. Traders and policymakers are left to navigate a landscape marked by uncertainty and rapid change. For now, a comprehensive Russia-Ukraine peace deal remains just a possibility, but even the prospect of an agreement is already shaping expectations and influencing trading strategies around the world. Ultimately, the outcome of these negotiations could play a defining role in setting oil prices for months or even years to come, making this a pivotal moment for the global energy landscape. Oil prices are shaped as much by politics as by supply and demand. A diplomatic move, military action, or peace treaty can move prices overnight. The U.S. quarantine on Venezuela adds a risk premium, while peace talks with Russia could unleash new supply. OPEC Plus decisions are political negotiations, with each country balancing its own needs. Security in Nigeria, sanctions on Russia, and U.S. policy all feed into the price you see at the pump. That's why energy analysts track both diplomatic cables and production charts. In oil, politics is business. Every global event can shift the balance and your cost of living. Oil prices aren't just numbers, they affect our daily lives. Lower prices mean cheaper gas, more money for families, and lower costs for businesses. When prices rise, it squeezes budgets and raises the cost of everything from groceries to airline tickets. Oil prices also impact heating bills and the price of goods shipped by truck or ship. That's why it's important to understand what moves the market. From Middle East production to South American politics, these forces shape our economic future. The story of oil is about jobs, budgets, and the well-being of our communities. It's a story that touches us all,